Good afternoon, everybody. Welcome to today's Exceed Capital Investment webinar. It's so great to see so many people here interested in learning more about investing with Exceed Capital, hopefully. And today's an opportunity for us to let you know a bit more about diversified funds and our diversified fund, the Collective Property Fund. A little bit of housekeeping up the top. We will be holding a Q&A session at the end. So if you do have any questions throughout our webinar today, please do not hesitate to pop them in the Q&A function. We won't be using the chat function today, just the Q&A. There are no silly questions. Feel free to pop anything that you're thinking through. If you're thinking it, most likely somebody else is as well. So let's jump in. Today we are joined by Exceed Capital's Head of Funds Management, Wayne O'Loughlin, who's going to run us through the funds management side of things. Good afternoon, Wayne.
Good afternoon, everyone. Hope you're all well.
We're also joined by the Managing Director and Co-founder, Vaughan Hain. Hi, Vaughan.
Afternoon, everybody. Thank you very much for joining us.
And my name's Eliza Bennett. I'm the General Manager here at Exceed, and I'll be facilitating today's webinar. A little overview of what we'll be talking through today. We'll go through a quick introduction of who Exceed Capital is, and then we'll jump into why we're looking at commercial property. We'll touch on investment terminology and run you through the basics of investing, as well as the benefits of a diversified fund. Finally, we'll touch on some of the reporting expectations, the Collective Property Fund, and run through that Q&A session towards the end. So to jump in, a little bit about Exceed Capital. So we have just settled on our latest acquisition, and that has taken Exceed to 16 assets under management, and we've hit our $500 million in funds under management, which is a very exciting milestone for us here at Exceed. We're also celebrating our 10 years in operations this year, and across that, we have a wonderful average cash return of over 8% for our portfolio, as well as a tracking IRR of over 20%. So today we're going to run you through the overarching view of a diversified fund and what to look out for as a new investor. And then at the end, we'll touch on Exceed Capital's way of working. So I might throw it over here to Vaughan, and we'll jump into it. And Vaughan, why should investors be looking at commercial property at the moment in such a volatile market?
Sure, there's various reasons why commercial property is such a great investment in a volatile market. And most of all, I guess, first of all, it does have lower volatility as an asset class compared to other asset classes out there. So especially that in the unlisted property space, because you don't have speculation of investment by people and that side of things. Another reason is that you've got very strong supply and demand dynamics. So good quality commercial property is always in demand, and as long as you're buying good quality property in good locations, it's always sellable as well. So the other factor is that to take into consideration is obviously growing regions as well. So take Queensland, for example. It's expected over the next few years that Queensland will grow by another 2 million people as we head towards the Olympics in 7 years' time, which will mean that we also need around 900,000 new homes as well. That's going to flow through to people needing more jobs. There will be more requirement for office space and various other assets as well. Also, the cash flows of property are indexed or hedged, you can say, against inflation. And what that means is the underlying leases there, where the tenants are in those properties, they have annual rent reviews. It could be anywhere from 3.5% or different percentage per annum, which hedges against the increase in inflation over time. Also, you've got the stability of cash returns in property because it is underlined by those leases or backed by the security of leases behind those and companies behind those leases. Also, property is good where you're able to scale by pooling capital together. And that's where trust structures work very well, where you can combine multiple people's capital to be able to buy better quality property. So therefore, you may end up with, let's just say, a shopping centre with a tenant like Woolworths or Coles. Versus if you just were out there buying an individual property yourself, it may only be a tenant covenant, like a local mechanic or something like that. No offense to mechanics out there. I was just using that as an example. Property is also very tangible as well. So you know exactly what you're buying. You can touch it, you can feel it, you can go and monitor it, make sure it's working properly, opposed to investments in other asset classes where you're purely reliant upon the reporting of what's happening in that company and hoping that that's accurate. So yeah, there's various great things around property which we like.
Absolutely. It sounds like it is quite a secure investment strategy in the current market. So are you able to take us through where the market is currently sitting and what investors should be looking out for at the moment?
Yeah, sure. So at the moment, we see that there is very good buying opportunities in certain aspects or regions of property at the moment. Naturally, across the industry, we're all seeing higher construction costs. That has been rising ever since COVID, and even prior to that, it has escalated a little bit more, and the same with labour costs. But what that means for property is that those higher costs with regards to labour and construction means that there's less supply coming onto the market. So what does that mean is that buying existing assets is a good thing because you generally be able to buy those well below replacement cost. Sometimes we're buying those at sort of 40 to 50% below some of the replacement costs, depending on the building, the location, etc. Other things are there's a population growth coming, or it has been here, sorry, for a long time, but it's going to continue to grow. And that's, for example, the Gold Coast, where it was the fastest growing population area in the whole of Australia. That has since recently moved to the Sunshine Coast, and the Gold Coast now is second with population growth. And as for example, with the Gold Coast, there's about 600,000 people there in the main area of the Gold Coast, not taking into account hinterland and that sort of thing, where that's expected to grow to over 1 million people in the coming years. What does that mean as well, which we're already seeing in that market, is that there is a escalation in rents, and that is part of the movement of businesses moving to what's called a flight to quality, so better quality assets and better locations, and that's had an impact, a positive impact on rent. When I say positive, as a landowner or landlord, on rent, where in the Gold Coast we've seen rent escalate some 40% over the last 2 to 3 years across some of our properties. So we're the largest office holder now in the Gold Coast, and we've been able to take benefit of that, which has been fantastic for all of our investors involved.
Thanks, Vaughn. It sounds like there's some really great opportunities out there in the market that savvy investors need to come in and grab a hold of. I might throw over now to Wayne. And can we touch on some of the basics of investing and investing through commercial property? Can you help let our investors or potential investors understand what to look for when talking about target returns? What does that mean? What should they be looking for?
Yes, sure. So it's a very good question. I guess the thing at the top of everybody's mind when they come to a fund manager is how much am I going to make? So make sense to talk about the at some point in time you're going to have more than you initially put down. So the difference between what you put down and what you get back is what we call the return in our industry. It can be measured in different ways. One of the common ones is a cash return, or as you might have heard earlier, annual rate of return. A cash return is a simple metric which we often use, which is basically the cash that comes into your pocket of your investment, either over a annual period or over the full life of the investment. So that one's very simple. As an example, if you say you put $100,000 into an opportunity and you had an 8% cash return per annum, that's $8,000 cash in your pocket per annum. So the internal rate of return, it also measures those cash flows, but also takes into consideration the capital growth that may be received upon the disposal of the asset at the end of the investment time frame. So typically your IRR will be a lot larger than your cash yield because it does take into consideration that capital growth, whereas cash yield is in your pocket. Bigger is not always better. Do not fly towards the light. Sometimes a higher return can actually be indicative of higher risk. And sometimes if you, depending on the underlying fundamentals of the asset, you need to analyze it to ensure that the risk that the return that you're receiving is commensurate with the return that you're receiving. So if you look at this graph that's on the screen at the moment, it sort of categorizes investments or assets into three buckets. So core, value add, and opportunistic. They've all got different risk profiles attached to them. And as you can see with the blue line there is that trade-off between the additional risk you take and the return that you're expected to get. But keep in mind, obviously, when there's a higher degree of risk, the probability of you getting that return does fall. So just to quickly go through these categories, is your more stable assets. You might have longer term leases, stable tenants, whereas the opportunistic, where you're likely to get more of a return with the higher risk, might be there's a development project or you've got to reposition the asset to really unlock those returns. But until you do, it may not be anywhere near the return, that premium return that you're expecting on the investment. So it really does vary based on your returns with your level of risk. As I said, the higher is not always the better. And at Exceed Capital, we try to focus on that Goldilocks zone, which is around that value add area in the middle, where there is proactive management opportunity. There is the ability to extract upside out of the asset, but also not exposing to investors to too much risk.
Thanks, Wayne. Yeah, it really comes down to investors understanding their own risk profile when selecting which opportunities to take part in. Going back to those cash returns, are you able to jump in and give us a bit of an understanding on distributions?
Yes, so not to be confused with dividends. So this shares that you might be invested in, you get a dividend in some circumstances. So you might get an annual dividend or a quarterly dividend, depending on the asset. So with our structure and with in property in general, in the funds management industry, it is typically under a trust structure. And under trusts, there is distributions of the profits of the trust. So being real estate backed and as the core property within the trust, it's backed by long-term leases to our tenants. So those tenants are generating a rental income for the trust. Those funds are applied to operational costs, your interest costs of the trust, depending on your level of gearing, and eventually you get to a net income position where you have surplus distributable capital, and that gets surplus distributable income, which then gets passed on to investors through distributions. And best market practice at the moment is monthly distributions, which supports the long-term goals of a lot of our investors because it helps to fund the lifestyle, particularly those that might be in retirement era, they're not on the tools anymore, and they're looking for that additional cash flow to supplement their lifestyle. So that's what it does deliver. The other thing with distributions is, and through a trust structure, is that we can pass on tax deferred benefits. So these arise from depreciation and amortization within the fund that we can pass through to investors. So what that means is that at a high level, it means that it reduces the income tax payable on those distributions, which ultimately leads to more cash in your pocket.
Wonderful. Sounds like another added benefit for our investors. You touched on the risks earlier. when looking at our target returns. Are you able to run us through what some of those risks are?
Yes. So when we assess any asset opportunity, we look at three major categories of risk. So the asset, the financial component, as well as the broader environment. So it's very important, as I mentioned before, when we're assessing the performance or projected performance of an opportunity, that's considered against those risks. So, at the asset level, you could be looking at things like, your tenant leases, how long's left on them, how stable the tenant is, what industry they're in and how stable that industry is, whether there's any risk of upcoming vacancy periods, has the vendor fixed all of the combustible cladding, or is that going to be a potential $2 million bill for us? Same with the air conditioning, is it coming to end of life? Are we going to need to forecast for that? Those sort of risks that are in there that are inherent to the actual building and its operational level. Then there's the level of the financial. So when we're doing our financial modeling, considering things like, are we able to achieve a certain return level that's going to be satisfactory to our investors, but also not taking on too much gearing or debt level? Is it sustainable at say 50% or 55%? Are we going to be able to maintain adequate interest coverage, especially in the event of say losing a tenant, because you do not want to be in default with your bank, and also whether conditions allow for us to hedge against some of those risks, in particular interest rate risk, for example. Pardon me. And whether the market allows for that. So can we take some of these risks off the table, or are they prevalent? We'll always come to the decision as to whether we acquire an asset. And risk doesn't necessarily mean no. Like the more risk you have, obviously, you're likely to get a higher return forecast out of it. But in many cases, you can mitigate the risks, and that's what active analysis is about. And when you can manage it or mitigate those risks, that's when sometimes the risk trade-off pays off. And just to touch on the environment there, we can find out a lot of things about the demographics around, say if it's a retail asset, we can look at things like, how many people are in the catchment, what's the catchment growth, what's the likely turnover of the major going to be, and how's that forecast to increase over the next couple of years to determine whether it's a stable asset going forward. And then there's the things that are sort of outside of your control, like what's happening overseas at the moment. That's going to put supply shocks throughout the economy, which is going to increase our operational costs. But there are other ways you can mitigate that as well. So it's about assessing the risks and also about seeing the ways you can mitigate them.
Thanks, Wayne. Yeah, it really sounds like that due diligence process is key here to understanding those risks, so you have the opportunity to mitigate them, as well as then make those informed decisions.
That's right. And you just got to, when you're picking a manager, you just got to be certain or, trust that they're going to be able to identify the risk. Because, I just spilt off a couple off the top of the mind. But there are so many risks in so many different areas that when you're backing a fund manager or an investment manager, you've got to make sure they're identifying these and putting in place the structures to mitigate those risks.
Absolutely. Alignment with the right fund manager is key here. So they take the brunt of those risks and understand what they need to do so your investment's safe. So at Exceed Capital and in the market, there's two different kinds of funds that we talk through, open-ended funds and closed-ended funds. If you're able to talk through what the difference is there and what each of them looks like.
Of course. At a high level, an open-ended fund is there is no end date to it, and I guess that's the key difference between an open and a closed-ended. We're constantly raising capital, or an investment manager is constantly raising capital, which provides naturally more liquidity within the fund. What that means is there's liquidity. Additional liquidity means you can acquire other assets within it, so you can achieve diversification. But also it means there's high liquidity for investors as well. So that means earlier redemption periods, which means that you're not tied in for long terms, whereas you might be in a closed-ended fund. So it's really about an open-ended fund is about building and growing the fund, as opposed to just what I'll explain is the closed-ended fund is about acquiring or raising a certain amount of capital to acquire potentially one or two assets within the fund, and then that's it. Once that capital is raised, it's closed, and you usually hold it for a defined investment period, and it can typically range between 5 to 10 years. So that's more appropriate in the circumstances where there might be a project, or there's some sort of repositioning strategy or capital growth strategy, where you don't want in and outs early in the piece, because you've got to take the time to really realize that value. So the downside of that is there's lower liquidity. So anyone who's investing in a closed-ended product needs to be on board for the full investment term that's defined in whatever disclosure document has been released, typically an information memorandum, and it's obviously quite different than the open-ended, where it is the higher liquidity. One thing I did miss on open-ended, because of the ability to continue issuing units, it also allows for dividend reinvestments. So rather than always electing to take cash distribution, which is the case with closed-ended fund, in an open-ended fund, those, rather than getting a cash flow, you can put that back into it. So your investment actually growing over time, which for some people that is a strategy that resonates with them, because they don't want the cash, they just want to see their portfolio growing over time.
Gotta love that compounding investment structure, hey?
That's right.
Overarchingly, sounds like both structures work well. It really just depends on an investor's goals and their timeframes of investing. But seeing as we're here today to talk about a diversified fund, do you want to run through what the benefits of a diversified fund is for a new investor?
Yeah. So basically, it's just like that first point. That's the key point there. I know I keep harping on about risk, but ultimately we are risk managers. Diversification is about spreading risk. And if I was to give a simple example, imagine a property that has a single tenant. It's returning 10%. If you lose that tenant, your 10% can go to 0% overnight as performance. Whereas compare that to a portfolio of properties that have multiple tenants in each asset. If you lose one of your tenants, then it's not such a problem, because you're still going to have your rental income coming from all the other tenancies. So it's really about getting scale, and enough scale, so that way your performance becomes more reliable over a period of time. Because ultimately what you want with an open-ended diversified fund is that stability and consistency, and in particular with your distributions, making sure that they're largely unaffected when some things like your vacancy risk arises. So as I said, it's mostly about smoothing out returns and keeping as much risk off the table as possible.
Perfect. Now, last one, I'll give you a break after this. But as investors are out there,
that'd be good. I'm out of water.
Investors are out there looking for a new fund manager or investment opportunity. When it comes to reporting expectations, what should they be looking out for, and what should they expect their fund manager to be delivering?
I guess, like that first point, transparency is key. You're putting your money with someone. You want to know what's actually happening with it. You want to know the good news, and you want to know the bad news. Mentioned multiple times through this, there are risks inherent in all a manager that's not going to bad news, because bad things are going to happen. It's really about what they're doing to make sure that they're addressing bad things that have happened. So making sure that transparent communication comes through on a basis. What you should be getting is on a 6 monthly, some managers are annual, is a full reporting pack. So that should include all financial metrics, how performance, an update on the idiosyncrasies of the particular asset, and any other disclosures that are required. There's also should be ad hoc disclosures as well. So, through the form of newsletters or communications. Each manager does it differently, but what we do is send out a newsletter every time there's a piece of news, and that should just communicate, those little losses in between time that you want to be aware of, because ultimately, you want to be across everything that's happening with your money and your investments. As well as the annual financial reporting. the tax statements. So, give a breakdown of what your income distributions were, whether there's any capital returns, your tax deferred benefits portion, also supplemented by audited accounts. So just so that you're sure and your accountants are sure that the financial details you've been presented are accurate. Also, unit holder statements and typically market value statements, which is very important for SMSFs, showing the market value of the fund based on the net asset value position at 30 June each year.
Perfect. So it sounds like transparency, clear communication, and making sure you've got that clear alignment piece with your fund manager is just absolutely crucial across the board, especially when it comes to reporting. Now, right. I'm going to throw back over to Vaughan. And are you able to take us through what the fee structures look like across the market? And then what is the approach that Exceed takes when it comes to fees?
Yeah, generally there's a range of fees on products like this. There's what they call one-off fees, which are basically fees around acquiring the property, doing the analysis, doing the due diligence, all of that side of things, the modelling, etc. And then there's other fees which are ongoing fees. First of all, the one-off fees or can be called upfront fees. Like I say, are often it's classified as an acquisition fee and a due diligence fee. That's typically in the industry anywhere up to sort of 3 to 4%. And then you've got a ongoing fee, which is often called a management fee for managing the investment and the reporting, the structures, all the returns to investors and that side of things. And that's a management fee, and that's often typically in the industry is based on assets under management. Where we differentiate ourselves to the industry is that we actually charge ourselves charge on a percentage of income, which is 7% of gross income. And that means that we are absolutely aligned to our investors. So in the example Wayne gave earlier, where if you had a single asset building and you had a 10% return, and if you lost that tenant, well, under assets under management scenario, which is the general industry, they still continue to charge a fee on that, on your investment, even though you're not getting a return. However, the way how we're aligned with investors is that if that happened and investors' return dropped, our fee drops as well. So we're absolutely motivated to maximize the occupancy in the building and maximize the returns back to investors. And even if you worked out our fee backwards to an asset under management scenario, we're lower than the rest of the industry as well. Another one there is a performance fee, which is typical in the industry. And what that is about is excuse me, at the end of your investment, when the asset is sold, if the manager outperforms over a certain percentage over what's called an internal rate of return, an IRR, there are times where the manager is entitled to a fee. So it's important to understand that fee as well, where some of those fees can be very heavy or can be sliding scales. The typical industry is somewhere around 20 to 25% over a certain hurdle IRR. But it's good to understand across the board your fee structure, because at the end of the day, you want to make sure that if your manager is getting those fees, which they will be, that you're also getting the returns that you want under that investment as well.
Thanks, Vaughan. Absolutely. Alignment seems to be key here between the fund manager and the investors. But it's also a key thing there for investors to understand when they're comparing funds across each other, whether it is assets under management or it's coming from income. While we're talking about Exceed's approach, I might throw it back to you and ask you, what is Exceed Capital's investing approach and our strategy?
Yeah, we take a top-down approach and also counter-cyclical. So what does that mean at a high level? First of all, the top-down approach means that, as you can see the chart there on the screen, it is around timing of markets, and every property subsector, meaning industrial, retail, hotel or office, all works in different trends. So at some points in time, those certain asset classes can be at the high of those trends, and sometimes are at the low of those trends. And so we look to, so there's what's called a capitalization rate or a cap rate in property, which is basically how you measure the back of a measure of value of a property on a back of an envelope approach, or a very simple approach. And we look at that on a daily basis, and we input a lot of data around understanding those trends of those different property subsectors. And then from there, what we do is we identify, let's just say at the moment, it might be office that we see as, let's say, compared to long-term averages, cheap at the moment. So then we look at that as at a high level. Then we drill down to the next level and work out, okay, well, in those areas, which area across Australia has got the lowest vacancy in that property class, being office, and then where there's additional areas for growth around that, which would be like population growth or economic growth in the regions, to understand the drivers of employment. You want to make sure that you've got multiple employment drivers in the area and not just reliant on one thing like mining, for example. You want to understand the vacancy and the absorption factor in those areas. So all of that is all the different trends that we look at. Another one, like I say, counter-cyclical, touching on that, is basically when a lot of the listed companies out there are selling and potentially taking large swings on their views of what's in fashion or out of fashion at the time. We will work counter to those. So when they are selling non-core assets, we typically may be looking to buy in those regions. So therefore, we can add value. We always have the slogan internally that we make our money on the way in and we crystallize it on the way out. And what is that all about? It's all about buying well for our investors to make sure that we can get very strong, good returns.
Absolutely. Very strategic and well thought out, which absolutely is from your leadership and your thoughts there, which brings me to the collective, which is one of your wonderful brainchild. Another very well strategic and very well thought out fund structure. Are you able to take us through a high level overview of the Collective Property Fund, our signature fund, that is our diversified option here?
Absolutely. Look, we're very proud of this as a team on this. A lot of effort went into the making of this with regards to the structuring behind the scenes with lawyers and accountants and all of that. We really wanted to make sure that this is an outstanding product in the industry and stands out with that. So what was important to us through it is that, first of all, the fund, being the collective, is a truly diversified property fund. What do I mean by that? It means that we are not just diversified across office or industrial. We have the ability to invest in all different property subsectors, depending on what's performing and what's not performing at the time. So that gives investors true diversification across a portfolio of great assets across different locations, different property subsectors, and even to the point where it has also a holding there of the ability to be able to hold other small portions in other asset classes, like the likes of cash, listed A-REITs to a small portion if we choose to, and even first mortgage securities. The other important thing was flexibility. As Wayne mentioned earlier, is that with our typical closed-ended products, which are fantastic products and investors love them, but they have a fixed period of time of typically 5 or 7 years. This product provides investors with flexibility to be able to come in at any point in time, not just when we're buying one asset, and that may only be once or twice a year. but come in at any point in time which suits them, and also have the ability for flexibility to exit if they may choose to. And that's typically after an investment period of 2 years' time. The other one was it's all about stability of cash returns. So strong, stable cash returns. And we're offering investors cash returns between 7 and 8% per annum. That's paid monthly. And we started the fund in the early days, where, when I say the early days, it's actually only approximately 9 months old, this fund, so it's still quite new, but it's had such rapid growth through it. But originally at around 7% per annum cash returns for a few months, but that's very quickly got up to paying 8% cash returns to investors and has stayed at that level ever since. So fantastic returns to investors, and that comes down to the 6 properties which are backed under that, which are diversified across various locations and also across the likes of medical or allied health, A-grade office, data centre, government. So we've already got a very strong diversification in there, even though it's in the very early days of this property fund. So we're really excited to see how this continues going forward.
Absolutely. It's definitely had a very strong growth over the first 9 months, reaching over 40 million in units issued already. And it's only going to get bigger and better. So please, can you shed some light on this new asset that will be joining the collective?
Sure. So what we have under contract at the moment is a exciting new asset which we will be purchasing into the collective, and that is based in Sydney. So in Sydney Olympic Park. So the tenant there tell us is it's their head office for Queensland, for Australia. They are a global tenant or global company in the defence space. So very, I guess, strong and stable tenant, which is fantastic. This property will be delivering from right at the beginning strong cash returns, which align in that 8%. So it absolutely aligns with our diversified fund returns there. And it's also backed, that tenant in that property is backed by very strong lease there, where they've got just under 7 years on that lease term still remaining there, which is very good. So that what's the benefit of that? Well, it's all about reducing risk and stable cash returns and stability of that tenant there. That tenant occupies the majority of the building, 5 floors out of 6, and then there's a few retail tenants on the ground floor there. The other benefit of the location is that some may be aware that there's a lot of infrastructure going to be put into that region even furthermore. And what are we referring to there is direct train networks into the Sydney Olympic Park region. One of the other reasons, I guess, is what we ask ourselves always in property is, why does the tenant need to be there? It's the why factor to make sure that they're going to be sticky to that building or that location. And the important thing for this tenant is that when they created the Sydney Olympic Park, it was obviously naturally for the Olympics. Well, they needed multiple sources of power supply to come in for that to ensure that everything was stable, rather than most areas only have one power supply coming in. So it's very important to this tenant tell us there, because as part of their occupation, or sorry, their activities, they have a component of a lot of data which is held on site and that side of things. So they need that uninterrupted power supply, which is important to them. And also they have a manufacturing area just down the road as well in the neighbouring suburb. So the headquarters being very close by, especially when they have this train network in place, it's going to make it even easier. It provides for a great location for that tenant there.
Thanks, Vaughan. It really sounds like another great, strong asset to be joining the collective. So thank you for taking us through that. We are now heading towards the end of our webinar. So if you've got any questions, please pop them into that Q&A function. But while you go ahead and do that, I'll just run you through what the next steps are if you're interested in investing in the collective. So first off, please get in touch with us. Reach out, whether it's via phone call or email. Come and ask us any of the questions. We always love to have a chat with new investors and existing investors too. Request an IM. If you haven't already received one, please reach out, ask for one so you can get into the real details. And then if any further questions arise, absolutely, please come back to us. Then submit through an application. As it is an open-ended fund, there is no waiting period in terms of the access to the funds. We process your application alongside the funds immediately, and they'll get processed through. And with that application, we will require documentation in line with your investment style, which will be different in terms of whether it's through a self-managed super fund or under an individual's name. All that information is within the information memorandum, so please reach out if you'd like a copy. So now let's get into it with the Q&A. So I've got one here for you to start off with, Vaughan. It's in regards to the liquidity option that is provided through the collective. It's the first time Exceed Capital's ever offered a managed liquidity option. Are you able to just run through that in a bit more detail? How will it work and why this time?
Absolutely. So as mentioned, under the collective, the benefit of it is flexibility. And that means that for investors, we ask that there is a minimum investment period of 2 years. And after that, we are offering what we're calling a managed liquidity option. So what that is that after 2 years of your investment, if you do choose that you want to either sell or reduce your holding in there, there's the option to be able to do that through a 6-monthly liquidity option. So that will be offered in March and September each year. And people, if they're wanting to, investors would put in a redemption request and have the request to, like I say, reduce or sell their holding. That is capped at the moment at 5% of equity and $5 million per annum. What would happen is that if it did go over that as a request, as a total, it would be paid out on a pro rata basis, meaning that if there was a redemption request for $10 million and we had a cap for $5 million, investors would get back 50% of their money in the first redemption request, and then they would apply again the following redemption of 6 months' time to redeem more of their units. We also are unique with the structure and around this product that we are always going to hold a minimum of 5% of liquid assets. So what does that mean? It means that they will always have money there to be able to fund that liquidity or redemption facility, unlike a lot of others which have had to freeze redemptions when people may want out.
Thanks, Vaughan. Sounds like it's been very well thought through. Hopefully that answers that question. Over to you, Wayne. It's your favourite topic of the day. How has the fund been structured to reduce risk?
Another risk segment. I swear I'm more interesting than this, guys. So it's like I mentioned earlier, we've achieved a level of diversification within the fund now, especially now it's got up to scale and it's got exposure to 6 buildings and with a different tenancy mix. So it goes back to that example I mentioned before of how that is spreading the risk across multiple locations, tenant industries, and asset classes. To go a little bit further into that, so how it's structured is it's actually we have a head trust and some sub-trust structures or entities within the group. And what that means is we purchase each property that we bring into the collective in those individual trusts. So they are quarantined from any, although it's within an open-ended fund and it's all grouped, it's still quarantined from the other assets. So if for, let's say, something went terribly wrong, touch wood, it won't, with one of those assets, it wouldn't have any crossover on the other assets within that fund. So each loan is secured against the property in that trust, and having the this instructs us to invest in other property related investments. So think of REITs if we have surplus cash. So that's a further avenue for diversification, although we haven't done that and plan to for a while until we increase the scale of the portfolio there. And another aspect that we address risk or manage risk within the fund is that each property is modelled separately. So we do look at the risks of each property independently when we're putting together the forecast, and that includes things like when we do our due diligence and find that there's there's a 5-year capex requirement. We raise those funds up front as part of the, or we target those funds up front for that life cycle. So that way we have the equity there to cover those costs rather than drawing from either other properties within the group or from the head trust. So it just helps to make sure, again, we're able to maintain consistent cash flows. And I think that about answers it, hopefully.
Thanks, Wayne. That's actually a perfect segment for the next question. So each opportunity gets modelled, but Vaughan, are you able to run through how the new properties entering into the collective, how they're screened and how they're chosen to be in the collective as opposed to a single closed-ended asset?
Sure. So what we've got for the collective is its own investment committee. So that's made up of 3 members of industry professionals. And what that is that each asset that is considered for the trust is independently scrutinised to understand the benefits and the risks around each of those assets, because we're all about stability of strong cash returns with this trust. So one of the key requirements is that it must deliver a cash return from day one between 7 and 8% per annum is key. We've also want to ensure where possible that we're purchasing below replacement cost. We have that saying that about, again, that you make your money on the way in and you crystallise it on the way out. So as mentioned, it's all about those risk buffers, which Wayne has been talking about, and making sure that everything is met. So, for example, we wouldn't put a building into the collective fund where it might have a significant value add component to it, whether it be development or it might be 50% vacant, and we need to move that up to 100% of occupancy, because that's unlikely to meet that 7 to 8% cash return from day one, and also it might have higher risk. And that's where we would often put an asset like that if we believed in it and it was the right asset and opportunity. We would put it into a closed-ended product where its risk appetite is purely described around that, and the information memorandum articulates all the plan around that and gives investors the opportunity, if they choose, to take a high risk investment.
Perfect. So it all just comes back to that earlier slide with the risk versus reward, and popping it back down on that more stable, less risk, but more stable, consistent income. It's great. So Wayne, you touched on the loan facilities before. Do we get an interest-only loan, or do we pay down principal and interest for each of these assets?
All of our loans are interest only. So what we do is we do typically have offset facilities against those or redraw facilities within the loan, and that allows us to reduce the interest cost of that debt, which is paid off on settlement. Oh, sorry, on sale of the asset. So we've generally get around 2 to 2.5 year terms. Is usually aligned with the weighted average lease expiry of the property. We've had very good refinancing. So a history of very good refinancing over our 10 years of operations. So it's don't know what more I can say.
Perfect. Interest only is the way to go. Sounds good.
About that, but yeah, it's interest only.
Perfect. Vaughan, touching on back on the property market, is there anywhere that we're looking in particular, and what areas are looking quite promising at the moment?
Yes, we're looking at all different areas. We mentioned obviously about the opportunity that we're looking at, or we have under contract in Sydney, which we're very excited about with those different stable assets. We personally like the office area at the moment. Why? It's just because a lot of the larger listed companies are selling out some of their non-core assets, mainly reasons not because they're out of love of office, but because of the fact that they're trying to deal with a few of their liquidity constraint issues at the moment and redemption issues with investors. So we are seeing some good buying opportunities in office where we're able to purchase buildings well below replacement cost. There is a shortage of buildings in some areas, in particular southeast Queensland, with the growth of interstate migration and that side of things, which we touched on earlier in the presentation. Other areas as well where we're seeing a bit of opportunity is that in medical, there's been a bit of a softening of capitalisation rates in medical and allied health. And we're also seeing industrial as well coming back a little bit, not quite to where we are ready to buy yet, but we are seeing it move back slightly in cap rates, meaning softening, which means the prices are becoming a little bit cheaper. So those are a few areas that we're monitoring at the moment on opportunities.
Perfect. Always on the lookout for something new bargain. That is it from all the questions. So I'm just going to pop in one final question because I love the answer to this one and I think our new potential investors should hear it. But how did you come up with the name The Collective?
Yes. So we have the slogan in our company called Collective Wealth Creation. So what does that mean? It's all about working together collectively to grow wealth together, rather than just the manager or just a certain party. It's all about working together. We're about collaboration and all working to gain wealth and grow wealth. So what that also ties into is that collective phrase is around also our values, which has been aligned with investors and all of us being equal in the way of, again, alignment and growing wealth together. So it comes down to the heart of all of our values, and it made sense that that the name The Collective was absolutely aligned with everything that we believe in.
Absolutely. It is so much in alignment with Exceed Capital through and through. So thank you for joining us all today. We hope that you've learned something, that you have something to take away from today. If you've got any further questions, please do not hesitate to reach out. If there's anything that you feel like we've missed, if you'd like a copy of the IM, if there's anything nagging in your brains that you'd like to find out, please don't hesitate to reach out. And yeah, we hope that you have a wonderful day. And we hope to see you investing with Exceed Capital soon. Thank you.
Thank you very much, everybody, for taking the time out, and it was a pleasure being involved.
Yes, thank you, guys. And just to clarify, that person in the picture on Vaughan's right is me. That is not a before photo of me. That's our other director.
Yes, that is Justin. Thank you all. Bye.
Thank you, guys. Appreciate it. Appreciate your time. Thank you. Have a good day.